From ancient temples to apps in your pocket, financial institutions have shaped how the world works. They're more than vaults or trading floors. They're the engines that move money, build cities, fund wars, and launch dreams. Some guard wealth, some grow it, some move it at lightning speed. For people, they've meant safety, opportunity, and access. For the institutions, every deposit, loan, or trade was fuel for profit. Across history, they've decided who gets capital, who builds empires, and who stays on the sidelines. This is the story of how those forces evolved and how they brought us to the trading world we live in today. Early banking systems. Thousands of years ago, temples and merchants became the first banks. People brought gold, grain, or valuables to store safely behind stone walls. It wasn't charity. These keepers could lend part of it out, earning more wealth from other people's deposits. For the public, it meant protection from thieves and a central place to settle debts. Instead of hiding wealth at home, you had a trusted hub. And those hubs? They grew powerful by moving and multiplying the value they guarded. It was the seed of a system where money didn't just sit, it worked. Traditional commercial banking. By the Renaissance, banks became grand institutions with ledgers, tellers, and marble halls. You could store coins, borrow for ventures, and settle trade across borders. Merchants loved it, moving money without hauling chests of gold. Banks thrived by charging fees and interest, quietly turning your need for safety into their steady profit. For you, it was about trust, speed, and reach. For them, it was about being at the center of every transaction, and once you used them, leaving felt impossible. Early capital markets. In 1602, Amsterdam gave birth to something new, a place to buy and sell shares of a company. Ordinary people could now invest in massive ventures like the East India Company. Why? The chance to share in profits that once belonged only to the rich. The exchange took a cut of every trade, feeding on the growing appetite for opportunity. It was risk, reward, and a public stage for wealth creation. Investors got a piece of history, and the market got its first taste of mass participation. Modern stock exchanges. By the 18th and 19th centuries, cities like London and New York built towering exchanges. Here, fortunes changed hands in seconds, and the house always took its fee. Companies raised capital, traders chased quick wins, and the exchange stood as the bridge between them. For people, it was a chance to grow wealth without building a business. For the exchanges, every tick of the market meant more volume and more profit. The floor buzzed with deals because everyone wanted in. Futures and options. Farmers, merchants, and speculators wanted to lock in prices before goods even moved. Thus, futures and options were born. Contracts for tomorrow's deals, traded today. It gave buyers and sellers certainty and gave traders a playground for leveraged bets. Exchanges earned by clearing these deals, no matter who won. It turned weather, harvests, and global events into daily opportunities. People used it to protect themselves or to gamble big. Either way, the system profited. Commodities markets, gold, oil, wheat, tangible goods that ruled economies. Commodity markets let you trade them without touching a barrel or a bushel. Producers secured prices, buyers locked supply, and traders surfed the swings in value. The exchange made money every time contracts changed hands. It was raw, global, and essential, and for many, it was their first taste of real-world speculation. Foreign exchange, Forex. When currencies began to float in the 1970s, a vast new market opened. Travelers, corporations, and governments needed to swap money daily. Banks and brokers took their slice on every conversion. Speculators saw the biggest market on earth, moving trillions each day, and wanted in. It was fast, volatile, and unstoppable. And for those running the trades, volume was pure gold. Electronic trading revolution. In 1971, NASDAQ went live. No shouting traders, just screens and electronic orders. It meant faster executions, tighter spreads, and markets that never truly slept. Brokers could handle more trades with fewer people, multiplying their reach. For traders, it was access at lightning speed. For the system, it was efficiency that translated into bigger profits. Retail investor access. By the 1990s, the internet brought trading platforms to living rooms. No need for a personal broker, just a computer and a connection. Millions joined, chasing returns from home, Platforms charged commissions, benefiting from the boom of small, eager traders. Finance became a personal game, and brokers made sure they held the cards. CFDs and leverage. Contracts for difference let you bet on price moves without owning the asset. Add leverage, and small sums became big plays, for better or worse. Traders loved the chance for outsized wins. Brokers earned through spreads and, often, when trades went against you. It was risk wrapped in convenience, and it drew people in like a magnet. Algorithmic and high-frequency trading. By the 2000s, algorithms could place and cancel thousands of orders in a blink. Firms used them to skim fractions of a cent, millions of times a day. It was invisible to most, but it shaped every price you saw. The tech owners profited from pure speed, while others tried to keep up. It turned trading into a race only the fastest could win. Mobile trading apps. Suddenly, you could trade anywhere, on a bus, at lunch, in bed. Apps like Robinhood gamified finance with slick design and zero commissions. For users, it felt like freedom. For app makers, it meant more trades, more data, and more ways to monetize your clicks. Trading had gone from a profession to a pastime. Cryptocurrency birth. In 2009, Bitcoin arrived. No banks, no borders, no permission needed. People flocked to it for freedom and the hope of explosive gains. Miners and early adopters benefited from a system where they set the rules. It wasn't perfect, but it was unstoppable. And it lit a fire under the idea that money could be truly ours. Altcoins and tokenization. Soon came Litecoin, Ethereum, and thousands more. Each promised new features, faster payments, smart contracts, unique assets. Developers and investors profited from innovation and speculation alike. It was a gold rush, but digital, and everyone wanted a stake. Crypto exchanges. To trade this new money, platforms like Mount, Gox, and Binance rose. They offered 24/7 access, global reach, and endless pairs to trade. Users got speed and variety. Exchanges thrived on fees from the non-stop churn of orders. It was Wall Street, without the closing bell. DeFi and decentralized exchanges, DEXs. Then came platforms with no central owner, just code. You traded wallet to wallet, no sign-up, no gatekeeper. Fees went to liquidity providers, not banks. It was finance without permission, and it put control back in your hands. But it also demanded you know the game, or pay the price. The trader's era. Now every market is at your fingertips. Stocks, Forex, crypto, all in one device. You choose your pace, your risk, your stage. Brokers, apps, and platforms compete for your clicks, your trust, your trades. The tools are here, the doors are open, and the only question left is, are you just watching history or making it? Subscribe for more stories and billion-dollar timelines. YouTube's got something it knows you'll want to see next. Trust the algorithm. It's smarter than you think.